We might have to adjust it if we have to. But I want us to look at this information that is provided to us. Okay. They're saying here the information given was taken from the accounting records of Valentino Limited for the year ended 30 June 2014. So this is Valentino Limited, is the company that has a financial 30 June. So if the year is ending 30 June 2014, when is it starting? What is the beginning of our financial year?
The 1st of July, 2013.
1 July, yes, 2013, 1 July 2013. So this is the beginning of our financial period. Okay, so what is required here? They're saying use the information given to prepare the following. So we must prepare notes to the cash flow statement in respect of cash generated from operations. I said to you, the most important note as time goes on, we will not do the other notes. We'll only be focusing on this one that we can expect from the exam. Number 2, cash and cash equivalents, dividends paid, income tax paid, fixed assets purchase. So these are the things that we need to calculate. This one, it doesn't need a note. You can just do a quick calculation for you to do your cash and cash equivalents. Dividends paid, you can do this using a T account. You can do this like by 2 numbers, which is interim dividends by the plus the beginning of shareholders for dividends. Income tax paid, you can just quickly do T account and then you are able to calculate your income tax paid. Fixed asset purchased, we're using general ledgers there as well, T accounts, and then you are able to do your to get your fixed asset that were purchased, fixed asset that were disposed, and all of that. Number 2, they want us to prepare the cash flow statement for the year ended 30 June 2014. They want us to do the cash flow statement for the year ended 30 June 2014. Okay, so here I have the information that is provided in front of us. Okay, extract from the income statement for the year ended 30 June 2014. So here they gave us the information that comes from the income statement. Number 1, we have sales, which is 1,300,000. We have operating expenses, which is 296,000 rands. We have net profit before tax, which is 240,000 rands, and then we have income tax, which is 72,000. Then we have net profits after tax, 168,000 rands. Then here they're saying note, operating expense includes. So these are the things that are included in the operating expenses, the amount of 296,000 that we have there. There's depreciation on equipment for 30,000. There's depreciation on vehicles for 45,000 rands. Okay, we know where that information goes to. It goes to the cash generated from operations. So we're going to use that information. Then interest expense includes interest on loan for 28,800, and then interest on overdraft for 2,400 rands. So this is what is included in the interest expense. Then we have summary of balance sheet as at 30 June 2014, 30 June 2013. So this is the current and the previous year. That's what they gave us. They gave us some notes. They gave us like the trade and other payable. So that is the information that we have, which is more similar to the one that we looked at before. Under the summary for balance sheet, we have what? Land and buildings at cost. They gave us the cost price of land and building, 765,530. Then they gave us equipment at cost. This is not the carrying value. I think that's another thing we need to be careful of. They can give you equipment at carrying value. They can give you equipment at cost. 220,000, 144,000 in the previous year. Accumulated depreciation on equipment, 78,48. Vehicles at carrying value, you can see here, they just gave you the carrying value, of which that is cost minus accumulated depreciation. We have beginning and then we have end. Fixed deposits, 40,000, 60,000. Inventories, 214,000, 144,000. Trade and other receivables, 381,200, 210. Bank were 50,000 rands in the previous year as a favorable bank balance. This year we have nothing. Bank overdraft with 0, and then in the current year we have bank overdraft of 29,200 rands. Cash floats 4,000, 6,000. Ordinary share capital 900,000 in the previous year, 1,160,000 in the current financial year. Distributable reserve, and then they say we must see note number 2, 154,000 with 70,000. Mortgage loan West Bank 240, 200, and then we have trade and other payables. See note number 3, which is 100,000 and 144,000. Then we do have this information here. Notes to the balance sheet: a new equipment was bought during the financial year. So which means now, under purchase of fixed assets, we need to be able to calculate this new equipment that was purchased. No equipment was sold during the financial year. So which means there will be no disposal under equipment. We need to be aware of that. When we do a T account for us to calculate equipment that was purchased, we must know that nothing was sold during the year. Number 2, a vehicle was sold at carrying value during the financial year. So we know there is a vehicle that was sold. Then we're going to calculate that as well, which is going to go to our investing activities. Then distributable reserves. What are distributable reserves? We must not forget, this is the same thing as retained income. They can call it distributable reserve. They can call it general reserve. They can call it other reserves. They can call it retained earnings, retained income. That is the same thing. You must, at a grade 12 level, because when you go to university, it's going to be different things. But for now, we must know that distributable reserve, same thing as retained income. They gave us the balance at the beginning, net profit after tax, which is 168,000. This 168,000 should be the same as the one that they gave us here, because it is the same information as you can see. And then we have dividends, and then we have balance at the end, which is 154,000. Trade and other payable consist of trade creditors, accrued expenses, SARS income tax. We know about this. Shareholders for dividends, we know about these two. What do we do about them? Okay, I'll just go up, okay, guys. Then we start plotting in the information where it's supposed to go. Let's start with this extract from the income statement. This is what we're going to start with. Extracts from the income statement. Here we have net profit before tax, we have income tax, we have net profits after tax. And you will remember the starting point for us is to do what? The notes to the cash flow statement. The first one, which is the reconciliation between the net profit before tax and cash equivalents. So net profit before tax, that is provided to us. How much do we have? 240,000 rand. So that is the net profit before tax that is provided to us. 240,000 rand. So what we're gonna do with these 240,000 rand, I'll take it and record it here as my net profit before tax. Then adjustment in respect of depreciation. We need to go and check how much depreciation that was provided to us. They told us we have 30,000 for equipment and we have 45,000 for vehicles. So which means now I'm going to say 30,000 plus 45,000, right? 30,000 plus the 45,000 rands, which is these two amounts. And then how much am I going to get? If I'm adding the two, 75,000 rands. It should be the 75,000 rands. We said here we're adding the depreciation, we're adding it back because it is a non-cash item. Remember, from this net profit before tax, depreciation was subtracted here. However, because we know that this is a non-cash item, no cash moved out of the business, we have to cancel it because initially we subtracted this 75,000 to get to this 240,000. Now that we understand that depreciation is a non-cash item, it means that no cash moved out of the business. Although it was an expense, we agree with that. But there is no cash that moved out of the business. So that is the reason why we have to add it back to cancel the subtraction that we did before. I hope that one is clear, guys. I hope that one is clear because depreciation is an expense. but we're adding it back to cancel the subtraction that we did before. Okay, then after that, we have interest expense. Let's go and see the interest expense that they gave us here. We have interest on loan, and then we have what? The interest on overdraft. They splitted the two as well here. 28,800, 2,400 comes from the overdraft. I think you saw from the I think you noticed that from our balance sheet that we have a bank overdraft. So they charged us an interest on the bank overdraft. But it doesn't matter. Both of these two, these are interest expense that should be recorded in the cash flow statement. Whether it's on loan or it's on overdraft, same thing. That is an expense that have been incurred by the business. So it has to, we have to remove it from this profit and then record it separately on the face of the cash flow statement. So how much is it? We have 28,800 plus 2,400. 28,800 plus the 2,400. Okay, so these are the two amounts. These are the two amounts. So how much we're going to have here? How much we're going to have here? We're going to have the 31,200. That's what we're supposed to. That's what we're supposed to have. It's supposed to be the 31,200. Okay, so that is going to be the amount that of interest expense in total. We must not forget that we record both of them. So I'm going to have 31,200. That will be recorded as an interest expense. We also add this one. We also add this one because it was subtracted here. So I'm adding it back. So then after this, which means now I can be able to get what? Operating profit before changes in working capital, it's going to be 364,200 rands. If I'm adding the three amounts, we're going to have how much? 346,200 rands. Okay. Then cash effect of changes in working capital. What's going on here? We need to check whether there was an increase or decrease in inventory. We need to check whether there was an increase or decrease in receivables, increase or decrease in payables. This is the working capital. When we're talking about the working capital, we're talking about three things: inventory, receivables, payables. That is a working capital. Why they're calling it a working capital is because that is the money that we're using on a daily operations. When you're selling trading stock, that is inventory. We're getting the working capital there. Because remember, when you invest capital into the business, you're going to take that money, buy the trading stock, sell on credit. So that is your money that is circulating. That is the capital that is working on a daily basis. That's why we're calling it a working capital. We need to go and check inventory, receivables, and payables and see what is the trend there. Okay, so which means now we're moving towards the direction of, and we've dealt with everything that is here, but we're still going to come back if there is a need for that. Then we're going to our summary of the balance sheet so that we can check this working capital here. Number one, what do we have? We do have an inventory there. We do have an inventory there, which is how much? Inventories from 144,000 in the previous year to 214,000 rands. So there was an increase in inventory. If you look here, there was an increase. So if there was an increase in inventory, is that an inflow or an outflow?
Outflow.
There was an outflow because
we bought more inventory, which means we used more cash.
Exactly. If the inventory increased, which means we purchased more inventory, which means there was a cash outflow because you are using cash to buy the trading stock. Okay, then how much is the difference? 144,000 minus 214,000. How much are we getting?
70,000.
70,000 rands. Okay, we're saying this is an outflow, so I'm going to have minus 70,000 rands. Okay, receivables. Now we need to go and check. We need to go and check the receivables. What is happening there? Trade in other receivables. There is it. So if we look at the trend, here, trade in other receivable move from 210 to 282, 210,000 to 281,200. Sorry. So which means there was an increase here again. There was an increase. So if there is an increase in receivables, okay? Increase in receivables from 210,000 and then it went to 281,200. So is this an inflow or an outflow? Increase in receivables.
Outflow.
Outflow of cash. Then why are we saying that?
Because the debtors aren't paying back on time.
Yes, they're not paying back on time, but also they're having our trading stock. That trading stock could have been converted into cash, right? But we gave them for free, not for free, but on credit without them having to pay it now. It's like we treat it as if we borrowed them money, right? If we give them our stock, it's like we're borrowing them our money, which is an outflow of cash. If receivables increases, it's like there is an outflow of cash in that scenario. Okay, so how much will be our outflow of cash?
74,000.
74,000 rands when we're saying 210,000 minus 381,000 rands. Is
I
it
made a
300?
mistake.
Sorry?
I made a mistake. I don't think it's 74,000 only.
Yeah, no, it can't be. How much are we getting? You do again.
$171,200.
171,200 rands. Okay, so that is going to be our outflow of cash in receivables. Then we go to payables. Then we go to trade and other payables. If you look here, we do have trade and other payables, but they told us to go and look at node number 3. The reason for that is, yes.
I have a question. Every time we do trade in other payables or trade in other receivables, will they always tell us to refer to the note, or you
Yes.
just have to do it?
You must, even if they didn't tell you, you must go and check if there is a note, because what we need to be careful of, we need to remove SARS there and shareholders for dividends, right?
Yeah.
Yeah, so all the time when you talk about trade and other receivables, here they didn't tell us about anything about a note, which means there's no note for this one. So which means now no SARS is included here, because SARS income tax can either be a receivable or can be a payable. So it's very important. Sometimes you will see a note number 2 under trade and other receivable, because in these two amounts we have SARS there that we need to remove. Then you must go to the note, remove the SARS. Sometimes SARS will be under payables. Sometimes SARS will be in both receivables and payables at the same time. Maybe last year will be in receivables, but in the current year will be in payables. It's possible. So you must always have to, you always have to check the note. As you can see here, trade and other payables, we have trade creditors, that is payables, accrued expense, those are payables. But when it comes to SARS income tax, they are still payable. By removing them, we don't mean they are no longer payables. They are still payables, these two. But because they have their own line items in the face of the cash flow statement, that's why we remove them. It's because of this reason. And you can see here, dividends paid and tax paid, they are here. They have their own line items. So that's why we don't treat them as payables. We remove them here, and then they're gonna sit on the face of the cash flow statement, and then they must not appear on this note. That's why we're removing them, because we don't want to show them on these trade and other payables in this note, because now it's gonna be like they are sitting in cash generated from operations, but they're also sitting here. It's double counting. So that is the reason why we have to always check the notes for trade and other payables, the notes for trade and other receivables. The next question we're gonna do, it will also consist of SARS income tax that is sitting in other trade and other receivables. Then shareholders for dividends will never be in trade and other receivables, will always be under payables. Okay, so we can see the totals here. We can see the totals here is 144,000 in the previous year, 100,000 in the current year. But we know very well that we have these two amounts that we need to remove here. We know very well that we have these two amounts that we need to remove. So what we're gonna do now, we need to calculate the new total, 74,000 plus 4,000. So that is going to be 78,000. So which means now our payables in the previous year, it will be 78,000. Let me just do it like here, 78,000 rands. And then in the current year, it's going to be the 38,000 plus the 2,000. So that is going to be the 40,000 rands. So what happened here with our payables? You can see now that our payables moved from 78,000 to 40,000 in the current financial year. So there was a decrease in payables. If I look here, there was a decrease in payables. So if there was a decrease in payables, what does that mean? Inflow or outflow?
Outflow.
Outflow of cash. If there's a decrease in payables, why outflow of cash?
Because we're paying what we owe.
Exactly, because we paid the people that we owing, so now we're owing less because we paid some of the amounts that we were owing in the previous year. That's correct. So I'm going to say 78,000 minus 40,000 rands. 78,000 minus 40,000 rands, and then how much are we getting? We're getting the 38,000 rands. Okay, this is going to be an outflow. So everything here is an outflow. Everything is an outflow. Everything is an outflow. So the total will be the 279,200. That is going to be the cash effect from changes in working capital. Then now, my cash generated from operations will be 346,200 plus 279,200, and then we're getting how much? Or 346,200 minus 279,200, we're getting the 67,000 rands as the cash generated from operations. These 67,000 rands will come here. 67,000 rands. It will come here. Okay. Then the interest paid. Obviously, we do have that information for interest paid. They told us the two amounts: interest on loan 28,800 and 2,400. So I'm going to have say here 28,800 plus plus how much? Plus 2,400, plus 2,400. Okay, so that is going to be my interest paid. I think we said we're getting 31,200, but that is going to be an outflow of cash. The reason why we were adding it here, we added it here, then we're going to subtract it separately in its own line item. Dividends paid. Now we need to go and check how much dividends paid we have. We do have a note that we spoke about for dividends paid, but I always encourage what? I always encourage I told you guys I encourage T account if that becomes possible. But let's look at the note perspective for now. Final dividends of the previous financial year plus interim dividends of the current financial year. Final dividends of the previous financial year, let's go and check how much is that. Final dividends of the previous financial year. Obviously, those final dividends, they will be here on the shareholders for dividends. So which means now my final dividends of the previous financial year will be how much? That is going to be my shareholders for dividends. Am I right if I say 30,000 is the final dividends of the previous financial year?
Yeah.
Okay, so which means we're going to have 30,000 rands here. Plus interim dividends of the current financial year. So how are we going to get that one? Interim dividends of the current financial year. We can see here they gave us the dividends, which is the total, which is interim plus final. But we do have the final of 48,000. We know that from this 84,000, we need to remove the final dividend so that we can get the interim only. Okay. So now, which means if we say 84,000 minus 48,000 rands, how much are we going to get?
36,000 rands.
36,000 rands. Okay. So which means what am I going to do here? I will say I need to do some sort of like workings. And I need to say 84,000 minus 48,000. Okay. Minus 48,000 rands. Okay. And then we're getting how much? 36, huh?
Yeah.
Okay. Then how much is the total? Then I just need to add the 2, and then we're getting how much? 66,000 rands. Okay. We're getting the 66,000 rands. Okay. There is another method, which is the second notes. Dividends for the financial year is reflected in the financial statements. How much we're going to record here? The dividends for the full financial year, that is going to be the 84,000 rands, as we can see from the retained income notes or the distributable reserves notes. That is going to be 84,000 rands recorded here. That is the dividends for the full financial year. Then balancing the shareholders for dividends at the beginning of the year, how much we got there? There is 30,000 rands. Okay. So I'm saying plus 30,000 rands here. Okay. Then less balancing the shareholders for dividends at the end of the year, which is how much? 48. Is it 48,000? Yes, 48,000 rands. That's what we're going to get here. So I need to say minus 48,000 rands. So these are the three amounts that we need to consider for us to get how much, to get the dividends that was paid. And then if I add all these three amounts, I'm getting the 66,000 rands. Okay. I did tell you guys that this can be done on a T account basis as well, so that you can know what it's possible to do it on a T account. I think I did show it to you before, how to do a T account for the shareholders for dividends. That is going to help you in terms of, if you don't have to do the note, you should be able to do what? The shareholders for dividends, right? The shareholders for dividends note. We have a debit and we have a credit this side. We must not forget that this is a liability account. This is a liability account, and we must know that liabilities, they increase on the credit side, they decrease on the debit side. So our balance carried down will be on our credit side, right? And then we're going to have our balance brought down on the debit side. Okay. Sorry, no, a balance carried down this side. And then here, this should be a balance BD. Okay. Then how much is our balance BD for shareholders for dividends? 30,000. It is our balance brought down 30,000, and then the balance carried down. How much is it? 48,000 rands. So I'm taking the 48,000 rands. I'm recording it here. And then now I need to get what? I need to get my totals under these balances, okay? Then we must have what? Dividends here. Dividends on ordinary shares, right? On ordinary shares. Dividends on ordinary shares. How much is that? That is what we're going to see on our retained income notes, which is 84,000 rands. I'm going to record my 84,000 rands here. You can see it's still the same information that is sitting in this note. Then you use the information to get your, if you look here, we have 114,000 as a total. So I'm going to have 114,000 here as well, which is a total. And then the difference between the two, I'm going to get what? I'm going to get dividends that was paid. So I'll say here bank. I will say bank here, and then this will be my dividends paid. You can see, guys, I did show this before. I'm showing it again so that you know what as much as they say this is a note, but it's something that you can do using what's the general ledger accounts. General ledger, they are very important when it comes to cash flow statement. Okay, dividends paid 66,000. So I'm going to say here minus 66,000 rands because this is dividends that's were paid. Then now tax paid, income tax paid. Again, we do have a note that is here for income tax paid, but it's something that we can also do using what? Using a general ledger account. It's something that we can do using a general ledger account. Okay, so let's start with the notes first. Let's start with the notes first and see if we can do it. Okay. Let's start with the notes first before we even come to the general ledger account. Let's start with the notes. They're saying here income tax for the financial year is reflected in the financial statements. Did they give us the income tax? How much is that? How much is the amount for income tax? They gave us 72,000 rands from the screen. If you look, guys, here we have income tax of 72,000 rands that is provided to us. So which means that is the income tax for the financial year as reflected in the financial statement. That is going to be the 72,000 rands that we can see there. So I'm going to say 72,000 rands. That is for income tax. Then now, balance in SARS income tax at the beginning of the year. So SARS income tax at the beginning of the year, how much was it? We're going to get it on the trade and other payables note. SARS income tax at the beginning of the year, we can see here we have 36,000 rands. That is the SARS income tax at the beginning of the year. I'm going to have 36,000 rands. And then SARS income tax at the end of the year, how much is that? We have 12,000 rands, which is the SARS income tax at the end of the year. Then that's what we're going to say minus 12,000. Okay, that's the amount that we have there. Minus 12,000, then we should be getting our income tax paid, which is 96,000 rands. Okay, on a T account basis, SARS income tax is a liability in this situation. So what am I going to do now? I need to say balance brought down, and then I need to have what? Balance carried down this side. Let's check the balance brought down first. Obviously, that is going to be the opening balance. 36,000 rands is the balance brought down. So I'm going to say 36,000 rands here. And then my balance carried down, how much will that be? My balance carried down, how much will that be? By looking at the information that is provided to us, let's go and check. That is 12,000 rands, which is the balance at the end of the year. I'm going to have 12,000 rands here, as you guys can see. Okay. After having the 12,000 rands, so I can start showing my totals now. I can start showing my totals line. Okay. Now, we know very well that there must always be income tax on our credit side. It will always be on the credit side. That will be the income tax. How much is the income tax provided to us? We can see here that we have 72,000 rands. So from this 72,000 rands, it will be recorded here. Okay, then you balance your accounts by getting the total on the credit side, which is 108,000. You transfer that to the debit side, 108,000 rands, and then the difference will be the amount that will be paid. So I'm going to say bank. This is what has been paid under SARS income tax, 96,000 rands. So I'll go to income tax paid and say minus 96,000 rands. Are you guys following?
Yeah.
Yes.
Okay. If you guys have a question, you must let me know. If there's something that you don't understand or it's not clear how we do it in terms of the workings, you must let me know so that we can talk about it. So we're done with our cash flow from operating activities. Then of which now I can get the total. Obviously, when we're getting the total, we're adding all these amounts, right? We have to add all these amounts that we can see here, all of them. Then we're going to see how much we're getting. By looking at the things here, this business, things are not going well. Because look at the cash flow from operating activities. 126,200, which is an outflow of cash. There's no business that can run like this. There's no business that can run like this. Cash is only moving out, it's not coming in. Cash generated from operation 67,200, but look at the interest that was paid. Look at the dividends paid. Tax alone is like more than the cash that was generated from operations. What are we doing in a business like this? Let's rather close the business and then we move on with our lives, because the business is not operating the cash that is required by the company. So, which means now the management of this business, they must do something. The directors of this company, they must do something to improve the cash flow. We can't have a cash generated from operating activities that is negative. That is an outflow. You'll see when you start doing the discussion questions that relate to cash flow statement, where you have to analyze the cash flow statement and what is contributing to this negative. Like tax, there's too much of tax that is being paid to SARS. There's too much of tax. There's too much of dividends. We need to cut out the dividends. We can't be paying 66,000 of dividends while we can see that the cash flow, we have cash flow problems here. You can't be paying 66,000 of dividends. You can't do that. Because look at the profits we made. We made a profit of 168,000 rands, right? From these profits, we need to pay tax. Oh, sorry, this is already after tax has been paid, is 168,000 rands. But also, and then we have what? We have dividends that we're paying from this one, dividends of 66,000 rands. But we don't have cash in the bank. We've looking at our bank account. Look, we have nothing in the bank. We have nothing. Previously, we had opening of 50,000. Now we have nothing. That's why we have bank overdraft. It's because we're paying dividends more, of which you're not supposed to pay dividends if you can see that the cash flow, the business has some cash flow problems. Okay. These are the things you must think about, guys. You must try to, let's think out of the box, analyze the cash flow statement while we're doing it. Let's identify the problems of the business while we're doing the question so that we can get to understand how we analyze those things. Cash flow from investing activities. Let's go and see. Cash flow from investing activities. Let's go and see. We know very well that investing activities, I told you what section of the balance sheet that we need to look at when we're dealing with this part. We spoke about this. Which section of the balance sheet we're looking at when we're dealing with cash flow from investing activities? Come, guys.
The current assets
Current
or the
assets.
fixed assets. I
Let's
mean,
come again. Mhm.
the part where it says current assets and then there's like long-term assets.
Current assets, there's long-term assets. Which section of the balance sheet? Which section of the balance sheet we need to look at? Are we looking at current assets?
We're looking at matured fixed deposit or fixed deposit. What do you
Yes,
mean, like
the section of the balance sheet? The section, which section of the balance sheet we're looking at when we going to calculate cash flow from investing activities? Where are you going to see these things on the balance sheet? Remember, the sections of the balance sheet. The sections of the balance sheet, we have non-current assets, we have current assets, we have equity, we have current liabilities, and we have non-current liabilities. Right? Which section here we're looking at for cash flow from investing activities? Where must I go here? Which section of the balance sheet I need to look at? Do I look at current assets? Do I look at non-current assets? Do I look at the equity? Do I look at the current liabilities or non-current liabilities?
non-current assets.
Non-current assets, very good. We're looking at the non-current assets. That is something that we spoke about, guys. If you remember very well from the notes that I gave you, we did say that for us to calculate the cash flow from investing activities, there is it here. Investing activities, we're looking at the non-current assets section of the balance sheet. You remember when I told you about this thing? Investing activities, we're looking at the non-current assets section of the balance sheet, including fixed or tangible assets and financial assets in the form of fixed deposits. This is exactly what we're looking at when we're dealing with the cash flow from investing activities. Okay. Let's go and see again how we're going to do that. Let's go to the balance sheet and look at that section. So we're done with all these inventories thing and okay, this is cash and cash. We're gonna look at it later. We're done with this part. So now we're dealing with land and buildings. Number one, there's nothing in terms of the notes that affects land and buildings. Land and buildings, it was 530 in the previous year. Now it is 765,000 rands. Did we buy land and buildings or we disposed land and buildings? Inflow or outflow? What is happening here?
It's additions or
Yes,
additions.
exactly. Additions, yes. We purchased land and buildings because they increased from 530 to 765, which means there were additional purchases of land and buildings. We have additions here. How much is our additions? How much is our additions?
235,000.
235,000 rands. So which means now under purchase of fixed assets, I know that I'm going to have 235,000 rands. That is the first purchase. I don't know if I have other purchase of fixed assets, but let's look at the equipment and cost. Here, if you look here, we have a cost price of 144,000 in the previous year, 220,000 in the current year. There was an increase in the fixed assets in equipment here, if you look at this information. But they said we must look at note number 1. Note number 1, what they're saying here, new equipment was bought during the financial year, no equipment was sold during the year, which means there was no disposal, but I know very well that there is an equipment that I have purchased during the year. Now we need to do that calculation. What is going to help you in terms of doing this is your general ledger account. Nothing else that is going to help you. It is your general ledger account. So we need to do our general ledger account for us to be able to calculate how much fixed assets, how much equipment was purchased during the year. So I'm going to have what equipment here, equipment, and then we have a debit, and then I'm going to have a credit this side. We know that equipment is an asset account. It increased on a debit side, it decreased on a credit side. So I'm going to have what here? My opening balance. I'm going to have my opening balance, and then I'm going to have what? My closing, which is going to be a balance carried down. Remember. Equipment. If I have the balance here, which is balance brought down, let's go and check here. We have equipment which is 144,000 rands. That is the cost of equipment we had at the beginning, 144,000 rands. Remember, now we're dealing with cost price. We're dealing with the cost price, not the carrying value. So there is that formula that we need to look at when we're dealing with fixed asset notes. Right? So we're not dealing anything with carrying value. Cost at the beginning plus additions minus the cost of the asset disposed is equal to the cost at the end. There's that formula that I showed you when we were doing balance sheets, fixed asset note. Cost at the beginning plus additions at cost minus the cost price of the asset disposed is equal to cost price at the end. So that's what we're going to do here. There is the cost at the beginning. Do we have the cost at the end? Balance. Carry it down. Cost at the end, how much is it? 220,000 rands. You guys can see here. 220,000 rands is the cost at the end. 220,000 rand is the cost at the end. Okay. Then now additions here. Let me just say bank. But this is actually additions on the fixed asset note. This is additions. Right? And then here, I'm going to have what? On the credit side, I'm going to have asset disposal there. Asset disposal. Asset disposal, I'm talking about the cost price of the assets that was disposed. Then now we need to, check. We need to check. Then now we need to check what is going to happen here. Sorry, this one is going to ruin my things. Okay, let me do this here. Okay. So guys, asset disposal, we need to check how much we disposed for the equipment. They told us here that nothing was disposed. If you go to note number 1, new equipment was bought during the financial year. No equipment was sold during the financial year. So which means now our asset disposal will be 0 there. And then we need to balance our account. So I'm adding my credit side, to getting 220,000 rands, and then I'm going to have 220,000 rands on the debit side. Then my additions, which is the bank, that is the purchase that I've made. How much will that be? 220 minus 144,000 rands. There's 76,000 rands equipment that we purchased during the year. So I'm going to say plus 76,000 rands. Can you guys see how we got this one? This is the equipment that was purchased. This time we did not use carrying values, but we used the cost. We used the cost. Remember, I gave you three formulas. When we were doing let me just go back to that spreadsheet, guys, because I want us to see what I'm talking about. I don't want to talk about something that you guys cannot see. You remember these three formulas? The one that we're talking about now is this. That first one. Cost at the end is equal to cost at the beginning plus additions at cost minus cost of the asset disposed. This cost of the asset disposed is the asset disposal that you can see here, which is 0. And then additions, you can see there is additions there, additions at cost. Then cost at the beginning plus additions. That is the cost at the beginning. This is the cost at the beginning plus these additions. Then minus asset disposal is equal to this one. That's how we get the cost of the asset that was purchased. Then what about vehicles? A vehicle was sold as carrying value during the financial year, but for vehicles nothing was purchased. So which means now in terms of the purchases of the asset, nothing else that was purchased. It's only the land and buildings and the equipment. So how much is it in total? 235,000 plus 76,000 rands, we're getting how much? 311,000 rands. But this is going to be an outflow of cash because we purchased fixed assets. Proceeds from sale of fixed assets, we disposed something. Okay, can I close this one now? Okay, let me just keep it a little bit. I can just close this part. Because we're not using it. The current tape. Now let's talk about vehicles. Now let's talk about what the disposal. Proceeds from sale of fixed assets. Any fixed assets that were sold. Looking at the vehicles at carrying value. If you look at our vehicles, they moved from 220,000, they went down to 135,000. 220,000, they went down to 135,000 rands. So which means there are vehicles that were sold during the year. So we need to go and check how much is that. Let's go to the transaction. They said a vehicle was sold during the at carrying value during the financial year, because they gave us carrying values here, which means we need to use the formula that talks about carrying values here. If I go to these formulas, which one talks about carrying values is the last one. So that's the formula that we need to use now. You remember I gave you these formulas when we were doing balance sheets, but now they're helping us in the cash flow statement. I did emphasize this to you guys to say these formulas, they will be very important for you. Now we're going to use this formula to calculate vehicles that were disposed. Because they're telling us here that a vehicle was sold at carrying value during the financial year, but we don't know how much is that. So now what I need to do another T account now. All right, I now need to do another T account for what? This T account is going to be for vehicles. So for me to calculate the vehicles that were disposed. So what I'm going to say here, vehicles. Okay, then I'm going to have my debit. Then I'm going to have what? My credit this side. And then my balance brought down is going to be on the debit side, just like the, oh, what's happening now? And my balance brought down is going to be, I don't understand what is happening. Okay, I'm going to have debit here. Balance brought down, that is going to be for my vehicles because we're using the carrying values here. Balance brought down, and then here I'm going to have what? Additions, right? Because this is the formula that we are talking about now. Then this side I'm going to have what? Okay, let me just say balance. Carry it down this side. And then I'm going to have what? My totals. I need to show my totals for both sides. Then now, this is the carrying value at the beginning plus additions. And then disposal at carrying value, right? Disposal at carrying value. So here I'm going to have bank actually. Also looking at the disposal at carrying value. Okay. Then I'm going to have what? Depreciation here. Okay. For me, I will be able to get, by doing this, I will be able to calculate the assets that were disposed. So let's go and see again. Let's go and see. Vehicles at carrying value at the beginning is 220,000 rand. So here I'm going to have what? 220,000 rand at the beginning. Then at the end, how much is it? 135,000 rands. That is the carrying value at the end. 135,000 rands. Okay. Then do we have additions? What did they say about additions? Did we buy anything on the vehicles? A vehicle was sold at carrying value during the financial year, but we did not buy anything. We were not told about anything that was purchased on the vehicles. So I'm going to have 0 on the additions. Then disposal, that's what I'm looking for. Disposal, that's what I'm looking for. A depreciation, how much is the depreciation for vehicles? Let's go and check. Depreciation on vehicles, we have 45,000 rands. There is it here provided to us, 45,000 rands. So I'm going to record it here, which is going to be 45,000 rands. Okay. Then now I need to take my total on my debit side, which is going to be 220,000. And then on my credit side, I need to have 220,000 rands. And then now I need to check on my credit side, how much will be my disposal. And now you can see that our disposal is 40,000 rands. This is our disposal. So which means now on my proceeds from sale of fixed assets, I'm going to have what? 40,000 rands. Right? You can even do your workings by saying 220,000 minus 135,000 minus 45,000. So this could be your workings from your T account, from your general ledger. Then you done. So it's very simple like that, guys. Nothing we should be worrying about. And then the fixed deposits, looking at the fixed deposits, it's moved from 60,000 to 40. So it's going down by how much? By 20,000. So which means there is that fixed deposit that matured. So in this scenario, we did not place any fixed deposit or any investment, but instead we received 20,000 because the investment had matured. So investment placed is going to be 0, and then investment matured is going to be the 20,000, which is an inflow. You can see like this business, they cannot manage cash, if we're being honest. If we're being honest, they cannot manage cash. Here we have 60,000 minus 40,000 rands. They cannot manage cash, guys, because you know why I'm saying this. It's because here they also have, you can see 251,000 cash outflow from investing activities. Why are you buying so much assets? 311,000. But you're not using those assets to generate cash. You generate 67,000 per year, but you're spending 311,000 rand buying assets. Why are these assets not helping you to generate this income? Something is wrong with this business. Something is wrong with this business. For now, I will stop here. Any questions on your side, guys? Any questions from what we have done so far? Anything that is not clear?
No.
Okay, guys, these are the basics that we're looking at, guys. These are the things that we will still be talking about the same thing when we're doing the question paper. So these examples, they are very important. Please, let's take them serious. You need to practice them, guys. If you only like spend time with me here and then you don't practice on your spare time, you're going to have a problem. I'm not going to lie to you. This thing, you need to do it on your alone. You need to practice it again alone, right? You don't have to do everything with me. You also need to have your own